happy to introduce Anthony Rose today. He is the man behind BBC iPlayer and now the CEO and co-founder of SeedLegals. SeedLegals streamlines the legal aspects of starting, raising and growing your company, and it is now the largest closed-off funding rounds in the UK. And this has enabled SeedLegals to have a sort of bird's eye view on the funding. And Anthony is more than happy to share his insights with you.
All right. Hello, everyone, and great to see you. So what I want to do over 30 minutes is tell you the 10 top things. I said 10, it could be some other number. Do to get investment ready and close your funding round swiftly and efficiently. So hello, I'm Anthony Rose, founder and CEO at SeedLegals. As it's been said, I used to head up BBC iPlayer. After I left the BBC, I built a startup, sold it, built a startup, sold it, got tired of paying lawyers, met my co-founder and decided to change that. SeedLegals is now over 100 people, based in London. Everyone's working hybrid anyway these days. About 1 in 6 of all early stage funding rounds in the UK, about 1 in 5 or 6 of all EMI share option schemes, and about 1 in 5 of all SEIS in the UK is done through SeedLegals. So from that, from thousands of companies and thousands of funding rounds, we've got lots of data and lots of anecdotes to share. So what I want to do is, I'm assuming you're a founder at an early stage company. This might be your first funding round you're looking for, or maybe it's your second. So what I want to do is go through the key things that you need to look out for so you don't make the same mistakes as others and you get investment swiftly and efficiently. So without further ado, let me turn on screen share. And all right, so welcome aboard. So the very first thing, you've had an idea, you're in the pub, you've met some friends and you want to do a company. Now, the standard pattern, and everything you're going to hear from me today is about the standard pattern, is when you go from a hobby, yeah, we're having fun in the pub, we've got a cool idea, and you now want to turn it into something, what you want to do is you want to create a company. Having a company means everyone can assign the intellectual property to the company. So if anyone disappears, the idea and the event and your products and project can keep going. So you're going to create a company. You can do this on Companies House in the UK. The wonderful thing in the UK, it costs like £12 and it's super easy to do. But when you do your company, just create ordinary shares. Do not try and emulate Zuckerberg and make super voting shares, because your investors will just tell you to undo it. And 95% of the time, we see companies create 100 ordinary shares. This means less friction later. Occasionally, someone will have an idiot accountant that says to make what's called alphabet shares, A, B, C, D ordinary shares with different votes per share. Literally 100% of the time we see people do that, it has to be undone later. Because if investors see that you've done things to advantage yourself as a founder and disadvantage them as an investor, guess what? They've got lots of companies coming their way. They're just going to hit delete on your slide deck and move elsewhere. Anyway, thing one, incorporate as soon as you're ready to move from a hobby to a gig, 100 typically ordinary shares of £1 each. So the next thing you're going to do is you now want to get your founders to sign agreements with the company. So when you have an idea, the problem is, what if somebody leaves and they go, well, actually, that was my idea. And so that's about IP assignment. The second thing is, when you create your company, let's say there are 3 founders and they've got 1/3 of the shares each. Your challenge now is, if one of the founders leaves, they don't like it, they need the rent to pay, they need to get a proper job, you don't see eye to eye on the product, they pop out. If they've got no founder agreement and no share vesting, reverse vesting in place, it means that unless you agree nicely otherwise, they're going to keep 1/3 of the shares in the business. And they might claim that the idea and the intellectual property and the code is theirs. And now you're screwed. And you're screwed in 2 reasons. One, no investor is going to invest in the company when they see a founder dispute or a departed founder owning 1/3 or even 1/2 of the business. It becomes uninvestable. And secondly, If the founders have a dispute about the intellectual property, that's going to be seen by the investors, and again, you become uninvestable. So you want to do a founder agreement. You can do this for free on SeedLegals, and a founder agreement's got 3 important parts to it. 1, reverse vesting. It says if I leave any time over, typically the next 3 years, I have to give back, transfer back some of my shares to the company. Number 2, it has an IP assignment saying all the work we put into I put into this project belongs to the company. So if I leave, the company continues. And it also has a non-disclosure and a non-solicitation, so that if they do leave, they can't go, oh, great, I'm just going to take the code and I'm going to nick your team and go off and do it again. So that's step 1, company, and step 2, founder agreements in your business. So the next thing is you now have your core team of founders, and now you want to get other team members. And the problem is you don't really have money yet. And we'll get to that in a minute. So now you want to hire people. But when you hire people, you don't yet have funds to pay them, so you could give them equity instead. Or maybe you do have some funds because actually you're hiring a software developer, they still have to pay their rent. So instead of paying them maybe 50K a year, you're going to give them 30K a year and some shares or some share options. And the question is now 2 questions. Number 1, should you give them shares or share options? And number 2, how many should you give? So here's on point 1, the simple rule of thumb, which is if the shares have no value, so you've incorporated, you haven't got a funding round, you can happily give shares to people without tax issues. But as soon as the shares have a value, particularly if the person's an employee of the company, then not only does the employee have a tax liability, they get free shares that have a value, but the company has a tax liability, because if this person was an employee, the value you give them in shares could be seen as a deemed benefit, and the company may need to pay PAYE and national insurance and pension on it. It could be a disastrously expensive mistake. So your rule of thumb is if the shares have no value, give shares. If the shares have got value, give share options instead, and you'll create an option pool and you'll now give options. So that was thing number 1. But the next thing to figure out is how many shares and options to give. So here, let's say you've got an advisor and your advisor says, I want 5% of the business. So why do you have an advisor in the first place, by the way? So when you send out your slide deck, it's always good, or people think it's good. I'm not that sure there's that much value. I think people overvalue advisors a lot, because somebody breezes in once a month and says fine things and then disappears without knowing the real problem, I think, is less valuable than having a developer on board who's going to actually work with you 24/7 to build it. But let's say you have an advisor, it looks good on the slide deck, you think you need an advisor, and they go, I'd like 5% of the business in share options. Is that a good number? Is it a crazy number? Should it be 1%? How do you even decide? So here's what I like to do. When you're talking just percent of the business, it's hard to know what's a good number or a bad number. So the top tip is equate that into a pound value instead. So let's say your company has a valuation for your, that in a few minutes, but let's say the valuation you decide is £1 million. 5% would be £50,000 of value. And you can hire a developer for £50,000. Why are you going to give £50,000 value to an advisor who's going to breeze in once a month? I think that's way too much. But were you to say, I will give you £10,000 value spread over 2 years, that sounds right. So that's equity vesting over 2 years. Or maybe it's £10,000 a year and you do it over 2 years, so it's 2% equity. And now, whenever you give share options to advisors or to team members, in the same way that you would never pay one of your developers their entire annual salary on January the 1st, ditto, you shouldn't just give anyone a big chunk of equity. Because what if they're no good? What if halfway through the year, they get bored, you decide that their feedback is rubbish, they're not being helpful, in fact, they're being difficult because they want to drag you in a different direction, you want to get rid of them. And you don't want them keeping all of this equity. So again, you'll create an advisor or an employee agreement promising them shares or share options typically that will vest over some period. For an employee, it might be 3 years. For an advisor, that's normally a shorter term gig that you might want to renew or do again. So that might be over 1 or 2 years, the shares would vest. And if they leave in that period, they lose the part that hasn't yet vested and they keep the fraction that has already vested. And there's your nice win-win. And it keeps them on their toes because they know if they don't perform, they're not going to keep getting a nice chunky set of options up front, regardless of whether they perform or not. So the next thing is, if you've promised people share options, these options come from something called an option pool. What is an option pool? Well, you've got shares in your cap table, and an option pool is the right to allocate more shares in the future. So you do some shareholder resolutions, you can do all these on SeedLegals super easily and free, and you'll create an option pool, or as part of your next funding round, this is typically when it's done, because nobody has to make any more paperwork, it just comes as part of the funding round paperwork, you'll create typically a 10% share option pool. And this means that roughly 10% of the business's shares are available as options to give to employees and advisors and so on. So that would be the standard over many, many funding rounds. In the US, you'll hear people talking about 15 or 20%. Don't be tempted to make too large an option pool because all it does is dilutes the founders. So investors will sometimes push you to make a larger pool. This means you getting diluted. But if you don't allocate those options on a sale of the business, then you may end up having diluted yourself unnecessarily. But here's the top tip. We've recognized that at SeedLegals, and when you do your round, your next funding round on SeedLegals, you can tick an option saying, on a sale of the company, unallocated share options go back to the founders. And in this way, even if you make an option pool that's larger than you need, as the founders, you don't have to find that it's a major disadvantage to you. All right, so you've got the company incorporated, you've got the founders with their agreements, you've got the employees, you've promised them both share options, and you've given them hopefully some salary. And now you need to go off and get investment. So the very first thing you want to do is you probably want to get SEIS or EIS, Advance Assurance. So I think most founders know what this is. SEIS means an angel investor, someone investing personally who's a UK taxpayer, can deduct 50% of their investment in your company from this year's tax bill, or slightly lesser known, they can backdate it to last year as well. So that's a nice. And if they keep their shares for 3 years, they pay no capital gains tax. And if your company goes out of business, they can write off their investment. This is, of course, hugely helpful because for the investor, it de-risks it. For you, if your first funding round is from friends and family, it means if things don't work out, you can still invite them over to Christmas dinner because they still have written off most of their investment from their tax, even if things don't work out. So SEIS and EIS fuel the vast majority of UK early stage funding rounds. So SEIS Advance Assurance is a letter from HMRC saying that your company qualifies and you can then show this to your investors. And it's not legally required. It's a comfort letter for investors, but it's often the difference having your advance assurance, the investor saying, I love what you're doing, get back to me when you've got your advance assurance, versus I love what you're doing, send me a seed fast, or where do I invest? So if you think your investors might be looking for this comfort letter, it's worth doing your advance assurance. You can do that on SeedLegals. HMRC is making it harder these days. You need to meet or justify what's called a risk to capital. So they want to see the companies using it for development and growth. And you also need to provide details of, we think, about at least 25% of the amount that you want to apply for. So in other words, if you want to apply for £200,000 of SEIS or EIS advance assurance, you need to provide the name, address, and intended investment amount for at least £50,000, maybe a bit more, of investment. These investors who you list don't need to be committed. In fact, their investment might be contingent on your getting advance assurance. But even so, they are probably in, but not committed to do so. And of course, being HMRC, you don't want to just make up random names. So do go and find some investors up front that will likely invest to get past this seeming catch-22. And it's a seeming catch-22. The reason HMRC introduced this requirement to get some investor names in your application for getting investors is because they found too many people were doing speculative applications. It was wasting their time. So they said, come back to us when you've got some investors. Anyway, we can help you with all of that at SeedLegals. So now we come to the meat of the presentation, which is you've got everything sorted and you now want to go fundraise. So how much should you raise? At what valuation? So let's start with valuing your company, because the reason you have to create a valuation is when you raise money, your investors will get some fraction of the company based on the size of the amount you're raising versus the valuation of the company plus that amount of investment after the raise. So let's say you're raising £200,000 at a £1 million pre-money valuation. That means before the round. After the round, the valuation will be 1.2 million. The investors will own 200,000 out of 1.2 million, 1 in 6, 16%. So your question that you need to answer is, how do I pick a valuation? And your valuation needs to serve two purposes. One, so that you can find a number, and number two, so you can justify that number to your investor when they go, dude, how did you come up with this valuation? So how are you going to find a valuation? So there are, and here I'm going to stop screen sharing. So here there are a few ways you can go. So way number one, you can read TechCrunch and see the valuations listed there. But those are insane US valuations, and you need to take at least 1 0 off the end, because it's just not like that in UK or Europe at all. So that's no good. Number two, you can go to UK Tech News or sifted.eu tech publications that list lots of startup funding rounds and look at what's listed there. But that's no good either, because they just list, everyone is proud to say how much they raise, but nobody says the valuation. So that's no good. Number three, you can go to your accountant and say, can you help with the valuation? And your accountant will go, sure, are you profitable? And you go, well, you've got to be kidding. And they go, do you have any revenue? And you go, oh no. And they would say, are you likely to have revenue anytime soon? And you go, well, not really. And they'd say, are you losing money? And you go, oh yes. And they would go, so not only is your valuation probably zero, but remind me why you're not insolvent in the first place. So going to your accountant is useless, because your accountant is valuing the company essentially based on the accounting as of today, and you're picking a valuation based on future potential, which is the amount of equity that you want to sell to your investors. So that the accounting method is no good, which leaves method number four, which is you create a spreadsheet and a business plan listing revenue and P&L over the next 3 or 5 years. But that's a complete bullshit method as well, because you just make up numbers. You have no idea. There's no validation. So any astute investor who sees made up numbers, which might go, by the way, if you're looking to do this, and investors are always looking for a business plan, you might be showing maybe a 5x growth in the first year, and then 3x, and then 3x, and then 2 or 3x after that. Growth tails off slightly. If you're showing 20x year-on-year growth, that's very nice, but you're going to be bigger than BT in about 4 years or 3 years, which is fantastic, but statistically unlikely. So when I see business plans showing 100 million pounds a year revenue for your blockchain business by year 4, you can't take anything else seriously. I mean, it would be awesome if it were true, but statistically, you know, you're growing. Twitter didn't have that revenue after 7 years, so it's extremely unlikely, and therefore almost everything else in your presentation, number-wise, probably can't be taken seriously either. So the 5 or 3 year business plan is useful to see the ambition level, and for me, as an astute proxy investor, to see the numeracy of the founder or founders. It itself is not a useful way to value the business. So now, how do you value the business? And here, over thousands of funding rounds, I see a pattern which goes as follows. A couple of founders get together. Nobody invests on a PowerPoint, so you have to create a prototype, make some mock-ups, do user testing. And step 1, we see founders put a median of £26,000 of their own money into the business up front. So that's your sort of founder initial investment. And if you do your funding round on SeedLegals, you can select to get that money back again as a founder loan once the business becomes cash flow break even. Step 2 is companies or founders might do a friends and family or a bootstrap funding round, maybe raising £50,000. And then you might do an angel round from SEIS angel investors raising £150,000 or £200,000. And then you may do a seed round raising £500,000 to £700,000. And then you might do a Series A round raising a couple of £1 million. And actually, you can see a pattern here. What's happening is at each stage, you're raising 3 to 5 times the amount of last time at 3 to 5 times the valuation. The other thing to note is that for me, I think the formula for a startup is that you want to raise investment perhaps up to 3 times, after which the business is profitable and you don't need to raise again, or you're ready to sell the business and you as founders and the investors make a great return on your life's work or their investment. And if you think about it, if you raise 3 times, each time diluting by 15%, and you create a 10% share option pool, after 3 funding rounds, the founders still have the majority of the equity. So here I'm going to turn on screen sharing again, and I'm going to show you the magic formula. So the magic formula over thousands of rounds on SeedLegals is we see companies selling a median of 15% equity in a funding round. So that means your standard pattern is maybe I'm raising £200,000 at £1 million pre-money valuation, or I'm raising £500,000 at a £2.5 million pre-money valuation. And in each case, your valuation is about 5x the amount you're looking to raise. And that means the investors will own 1 in 6, 16%, which is exactly on the money here. So why is this useful? Well, firstly, it's something investors might often be expecting. But importantly, sometimes you'll have investors who are looking to get 30% of your business. And ironically, you think those are big bad VCs, actually who'll often be looking for 20 or 25 of the business. But ironically, the biggest mistakes people make is that friends and family end up with 30% of the business for their £20,000 investment. And how does this happen? Well, Uncle Charles says, I love what you're doing, you know, can I invest 20K? And you go, sure, but you know you've just been noodling for a few weekends on a PowerPoint. How can the business be worth any decent amount? So you go, great, I'll take your 20K, and let's say the pre-money valuation is 40K, and now the person owns a third of your business for their 20K, and it's a disaster. So if you give away too much equity up front, your business becomes uninvestable, and so that's a bad mistake to do. So you can see your standard pattern, several funding rounds, and now your valuations, I think, go something like this. A couple of founders get together, have a PowerPoint. Okay, maybe £300,000 valuation because you built nothing. Okay, so you've built a prototype, 600K valuation. You've got something live that's out there, maybe £1 million valuation. You've got users, maybe £1.5 million valuation. You've got revenue, £2 million or above valuation. And above £2 million valuation, it's usually based on roughly 10x annual revenue. That's just a ballpark, depending on how fast you're growing. It could be more, it could be less. But if you're doing, let's say, £30,000 a month in revenue, which a company with some saleable product can get to by a reasonable stretch of the imagination, then that's £350,000, £360,000 a year. You might say your valuation is £3.5 million or so. If you're doing £100,000 a year in revenue, that might be a 10 or 15 million pound valuation. Some investors will try and lowball you. Some you can push for a higher valuation. And obviously, if you're making vaccines or genetic stuff, it's going to be different to a mobile app. One's very CapEx intensive, one's not. So you now know how to value the business and how much potentially even to raise at different stages. And you can find all of this information on SeedLegals.com in the resources deal data section, which is a wealth of information on fundraising and founder shares and share options in the works. So everything you've seen here is about doing a funding round. And when we started SeedLegals, I was here to help you do a funding round. But I'm now here to help you not do a funding round. So what do I mean? Well, once upon a time, you had to get together, find a bunch of investors, everyone gets on the bus together, and you're going to raise enough to last you 12 to 18 months. Why? Because doing a funding round is difficult. You have to find investors, convince them to invest, agree a valuation, agree deal terms. And once upon a time, before SeedLegals, you'd spend 3 months finding investors and then 3 months doing the legals for the round. And then you have to begin planning the next round. And you have to get growth and traction, higher valuation to raise more next time. That takes at least 6 months. And you can't risk trading insolvent, so you need maybe 3 months at least buffer. So that's like 12 to 18 month cycle of this go big or go home. And it's hugely stressful. But why does it have to be that way? So what we've done, we haven't invented this, we've productized it, and we call it Agile fundraising. And it's to say that instead of needing to do a single funding round, what you can do is you can raise in bits and pieces ahead of a round. And then when you do a round, you can do a funding round for less than you totally wanted, and you can top up afterwards. And we call the so-called advanced subscription agreements, we call them seed fasts. They're insanely popular. You can raise from individual investors ahead of a funding round using a legal document, which essentially says the investor gives you money now, and it will convert into shares when you do your funding round later. And for it to qualify for SEIS, it has to convert within 6 months. To incentivize the investor to come in now, you might give them a 10 or 20% discount compared to the later investors. And if you don't do a funding round within 6 months, it will convert anyway at what you agree is so-called the long stop valuation. So we see on a rainy Sunday afternoon on SeedLegals, founders, they've met someone at an event, maybe on an event like this, or some London networking events that are back again. Then you meet an investor, and instead of them, when they say, can I invest 20K? Instead of going, come back in January, you'd love to use the money now, you can go, yep, let me send you a seed fast. And companies are raising maybe between 10% and 40% of the entire funding round now ahead of the round. But the other common thing we see at SeedLegals is founders coming to us going, I'm looking to raise 300K, but I've got 200 lined up. What do I do? Do I close a smaller round or I keep going? And there, the solution is what we call instant investment. So it's a rolling close round. You close the funding round at the smallest amount that you can corral together, but the deal terms and the legals allow you to top up later. So the combination of raising smaller amounts ahead of the round, because literally you didn't need £200,000 today, you needed £20,000 today to hire some iOS developers and so on to get going. So you now have the ability to raise a little before, do a funding round, and then top up. And importantly, you can use the money to grow your business, to grow the valuation for later. So now let me switch screen sharing, and we're back. So I think we have a few minutes for Q&A. I hope that was helpful. That's your formula for getting the business started and raising your first round. Thank you.
Yeah, thank you, Anthony. That was super informative, and you also really appreciated it. So we have a couple of questions. I can maybe run through them. So one is on your thoughts on convertibles. So you mentioned seed fast and the Agile fundraising just now. So maybe we can turn this question into why shouldn't you do a seed fast or a convertible?
Right, so that's a great point. So firstly, let me explain the difference between a seed fast and a convertible note. Seed fast is very much the UK equivalent of a SAFE in the US, which is very popular. A convertible, and the terms of a seed fast is I will give you money and it has to convert. I can't get my money back and I can't get interest. And it's that which makes it SEIS compatible. A convertible note is like the big brother of that. People are familiar with convertible notes, but just like the furore with Future Fund, the government's initiative, which didn't qualify for SEIS, because a convertible note can repay the investment and can give interest, those two make it not eligible for SEIS. So if you're raising, from institutional, you might do a convertible note. But if you're raising from angel investors, it's probably going to be a seed fast. So the question is, why not do everything in seed fast? And that's a bit of a pattern in the US, which is, I won't bother with evaluation. I'll just raise now with these sort of promissory notes, and we'll figure out in some years to come. The pattern doesn't really work in the UK because HMRC says it's a maximum of 6 months that it has to convert, which is not a problem. You can still raise with them and they just start converting in 6 months. But I would say you can do it that way, and I see companies doing it that way. But I think two things suggest the opposite, which is the idea broadly seed fast, a sort of bridge finance to your next round rather than a replacement for the next round. And the second thing is ultimately investors want their shares. So because they only get SEIS when they've got shares, the seed fast is the promise of shares. So you'll have some investors, you can see a seed fast being a promissory note in a sense. For the investor, carries a bit more risk. They haven't seen the shareholders agreement. They don't know the deal terms yet. So not all investors will go for it, but it's becoming way more popular these days. And I would probably say 80% of investors don't have a problem, but you'll find some will go, get back to me when you're ready to do the round.
Yeah, I think we have time for one more question. So from your perspective at SeedLegals, what change have you observed over the years in terms of funding rounds, valuation, and also what type of businesses these founders raise money for?
Great question. So I suppose two things. One, when we started SeedLegals, my assumption was going to be more sort of technical founders who are going to use a legal tech platform because others would go off and need lawyers and so on. And actually, it's proved to be the opposite. My delight is when there's fashion tech or food or med or something, and the founder is a domain expert at everything from vegan meals to clothing and they know nothing about funding or legals, and SeedLegals is just the perfect wealth of information that gets them up to speed. I think the second thing, my perception is that when we started SeedLegals, my assumption was people are looking for legals. Actually, nobody's looking for legals. You're looking for a solution to a problem. And that's the advantage compared to a law firm. So a law firm gives you a pile of paperwork. And my goal is to give you videos, articles, data, all the things I spoke about are commercial things. What percent equity should you give to investors? What should the valuation be? What percent options? This comes from data. And I think the most important final thing is that in the past, years ago, VCs led the round. So you'd go to, there was no such thing as crowdfunding, there's no angel investment, and you'd have to find a big, bad VC investor. And they would have really founder unfriendly deal terms. They would want preference shares with anti-dilution, board seats, a ton of investor consents, and kind of like run your business almost for you. And, you know, those days are somewhat long gone, at least in the early stage rounds. And there are two things that have changed. One of them is crowdfunding that says you'll have 500 people with no rights having shares, but that's got some, you know, its own set of limitations. But on SeedLegals, for the first time, founders are empowered. Instead of waiting for the investor to send you their term sheet with their sometimes crazy deal terms, you always want to own the playing field. And SeedLegals lets you say, these are the deal terms I'm offering you. And when it comes to angel rounds in particular, it's just perfect. Angel investors love it because they don't want to spend £10,000 on legal fees for their 10 or 20 or 50,000 pound investment. They trust SeedLegals terms and legals, and things complete way faster. So, you know, to me, the joy is when I get on a call with a founder who's got some wonderful, you know, idea and would have no way forward. Now to provide them the set of things to help them is, you know, a real privilege. And when I look at my Slack channel and see lighting up of companies on SeedLegals, I sometimes click on the URL and see what they're up to, and it's just a joy. And then I love to buy things from them as well. So cheese, tea, vegan, frozen foods, whatever it might be. So yes.
Thank you so much, Anthony. The session's come to an end, but it was super insightful, and thank you a lot for coming.
And thank you. And anyone who's got any questions, you can reach me, anthony@seedlegals.com, or connect to me on LinkedIn. And I'm a bit slow on my LinkedIn responses, but hopefully I'll get back faster on email, anthony@seedlegals.com, or just head over to the SeedLegals site and hit the chat button. And we're even around on the weekends and evenings as well. Thank you.